Okay, so today we're looking at a deep dive on Data Vault AI, or DVLT.
Yep.
And specifically that massive, plus 46% surge in just one day.
Right, the so-called triple catalyst event, but also the pretty serious financial risks that are sort of hiding in plain sight.
So let's jump right in. The analysis kicks off by highlighting these really ambitious revenue targets.
The $30 million for 2025, and then that huge jump to $200 million plus for 2026, yeah.
Exactly, big numbers.
But, the strength of that guidance is, I think, really undermined by how the financial headwinds are presented.
How so?
Well, the weakness is that you talk about the great news, the guidance, and then way later, you mention, almost as a side note, the $100 million net loss and the tiny cash reserves.
That $1.68 million.
Right. It just feels disconnected. So our suggestion is to immediately contextualize that guidance shock. You should tie the need for that massive $150 million investment agreement directly to the company's current cash burn.
Okay, so you're saying make that connection explicit from the get-go.
Precisely. For instance, don't just list the cash figure. Frame it as, this $1.68 million is the only resource they have to bridge the gap until the Triton deal's $8 million in fees actually materializes.
Got it. That makes the risk feel much more immediate.
It does.
And speaking of that Triton deal, that brings us to the triple catalyst itself.
Mm-hmm.
So the analysis breaks it down into three parts. The Triton deal, the guidance shock, and then the retail FOMO from that Dream Bowl 2026 meme coin airdrop.
And here's the next big point for improvement. You need to define the hierarchy of those catalysts to really sharpen the analysis.
What do you mean by hierarchy exactly?
Well, the weakness right now is that it treats all three as, kind of equal. And that really muddies the waters between what's a fundamental value driver and what's just purely speculative short-term momentum.
I see your point. But couldn't you argue the retail hype from the airdrop is actually more important in the short term? I mean, that's what drove that insane volume.
That's a great question. And it's exactly why we're suggesting a clearer structure. You need to distinguish which factors validate the real-world asset model, that would be Triton and the guidance,
Okay.
versus the factor that just fueled the explosive price spike.
The meme coin.
The meme coin. So a concrete way to do this would be to analyze if that retail-driven volume was actually necessary to clear that critical $1.75 to $2 resistance zone.
Or
if the institutional buying from, say, Vanguard and Geode was already enough to build that floor on its own.
that makes a lot of sense. So sticking with that resistance zone, let's look at the technicals. We know it cleared that zone. The RSI is high, which suggests volatility, and it needs to hold 220 as support for any push toward that $3 analyst target.
Right.
But then the analysis just kind of lists the institutional buyers, Vanguard, Geode Capital, JP Morgan. It feels really disconnected from the price action discussion.
Exactly. The technical analysis has to integrate institutional behavior as an active analytical tool, not just a supportive list you tack on at the end.
So it's not just an, oh, and by the way, institutions bought some shares too.
No. That's the current weakness. The suggestion is to use those specific institutional buying totals as concrete evidence for the strength or weakness of that new floor.
Ah, okay.
So, for example, you could hypothesize, are the combined, 1.1 million shares added by those big institutions actually sufficient to absorb the potential selling pressure that a high RSI suggests? Pressure that could threaten that necessary $2.20 support level?
Ah, so you're using their buying power to actually stress test the support level in the analysis.
Precisely. It connects the who is buying with the what of the price action.
This has been incredibly helpful. So to quickly recap the core actionable recommendations here. First, balance the financial risk narrative right alongside the reward from the very beginning.
Yes, connect the cash burn directly to the guidance.
Second, clearly distinguish the impact of each triple catalyst component to separate the fundamentals from the hype.
Right, create that hierarchy.
And third, use that institutional buying data as an active component of your technical analysis, not just as a footnote.
Yep, those are the keys. Making those changes will give the analysis a much sharper, more balanced, and I think a much more compelling edge.
Fantastic.
So refine those sections, really sharpen the focus on those causal links between the risk and the opportunity, and please submit it back to us when you're ready for a follow-up critique.